Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for December 2019. Let's take a look at key highlights of November 2019. US GDP expanded by 2.1% in the quarter ending September. This is on the background that it was expected to slow down. Hence, fear of recession in US economy has subsided to a certain extent. India's GDP growth came in at a low of 4.5% in Q2 financial year 20 as compared to 7% in the same quarter last year. This growth rate is the lowest in the last 26 quarters. Fiscal deficit till October end hit 102.4% of the financial year 20 budgeted estimate as government expenditure increased and tax collection fell in H1 first half of financial year 20. Food inflation shot up to a level of 6.9%, especially due to rising vegetable prices. As a result, though core inflation fell to 3.5%, headline inflation inched up to 4.6%. India's trade deficit in October stood at $10.9 billion as against $10.6 billion in September. In the month of October, while exports contracted by 1%, imports shrank sharply by 16%, resulting in subdued trade deficit. Benchmark index Nifty 50 gained 1.2% in November, thus resulting in 3 successive monthly gains. Post-corporate tax cut announcement, it had gained 4% and 3.5% in September and October respectively. Nifty Q2 earnings have shown signs of recovery with a 7% year-on-year rise in profit after tax, supported by corporate tax cuts and lower raw material prices. Global money supply growth may lead to stabilization in global economy, which in turn may prove to be positive for Indian equity, especially the mid-cap space. Since the time when we went tactically overweight in equities, Nifty is up 5.1%, mid and small cap index are up 7.5% and 5% respectively. In light of the recent trend, we retain our tactical overweight for now. However, we may revisit the stand in case the market strengthening continues. RBI is expected to continue with accommodative stance, which is likely to lead to policy rates at or below 5% in the medium term, while ensuring surplus liquidity in the system. Dwindling growth rate of economic activity may outweigh recent rise in inflation in MPC's decision-making. Sustained surplus in interbank liquidity, now averaging around 1.9 trillion Indian rupees, indicates better transmission of RBI rate cuts going ahead. The pace of transmission has started to pick up now that the regulator has mandated to link lending rates with repo. Proposed disinvestments of major PSUs like Air India and BPCL will help the government in meeting fiscal target. This may partially compensate for the loss of tax revenue, thereby preventing hardening of GSEC yields. As anticipated by us, easing of spreads has already begun. Hence, opportunity to lock in currently available attractive yields in corporate and NBFC bonds may vanish soon.